the impact of reduced risk weightages. So, could growth indeed pick up in coming months, which might lead to, among other things, the markets looking up, though the factors driving the markets are much more than just pure growth. You may remember that in November 2023, fearing distress in consumer loans, the Reserve Bank of India had tightened norm for personal loans and credit cards, raising the risk of slowing loan growth. The tighter rules in the form of higher capital requirements made loans costlier and did curb growth in these categories, which had outpaced overall bank credit growth of about 15% in the last year. The Reserve Bank of India had increased risk weights for banks and non-bank finance companies, or the capital that banks need to set aside for every loan, by about 25 percentage points to 125% on retail loans. Now, the Reserve Bank has pulled back and is easing off quite quickly as it tries to match the government's push to increase consumer spending, and presumably some of it through increased borrowing. On Tuesday, that's last week, it reduced those risk weights on bank loans to non-bank finance companies and also microfinance loans. All of this will be effective in a month's time. That's from April 1st. I reached out to Ajit Velonie, Senior Director at Crisil Ratings, and I also began by asking him how he was seeing the downstream impact of these reduced risk weightages on the financial system.
If you just step back, November 23 was when the Reserve Bank had increased the risk weights. There were two broad areas. One was the increase in the risk weights for consumer credit exposure, which is basically direct lending there. And the second one was the increase in risk weights to lending to NBFCs. I think currently now what the regulator has done is reduced the risk weights for lending to NBFCs. The impact is largely twofold. One, at that time, there was quantitative impact, because effectively banks had to set aside now more capital for the same lending that they were doing. But I would say more importantly, it was also a messaging from the regulator during that period, because we had a fairly high period of growth on the retail space, especially unsecured. And I think it was in a way a message from the regulator for the NBFCs and banks to be a little wary in terms of the quality of underwriting and to try and maybe just cool down some of the fast growth that we saw during that period. With this current reduction, I think it's also a positive messaging from the regulator, where potentially we have seen growth rate, for instance, the bank lending to NBFCs. If you go back to FY23, the growth was some 30 odd percent. Even till November, YOY growth was more than 24%. That had nearly flattened out over this last 9-10 months till November. At December, we saw a slight uptick. But basically, it's a fairly muted growth. So I would say this also means from a regulator perspective that there is some element of comfort that they could have derived in terms of the pace of this growth at this point.
And would the eventual outcome have been achieved, which is to really reduce or increase the scrutiny of small loans?
Absolutely. I think there is two elements to it. One, clearly that the regulator giving you an element of a warning saying that potentially there could be a heating up in the system. And two, with that, all companies that were the banks as well as NBFCs have had a complete change and refocus on risk management, quality of underwriting. I think the latter clearly continues to hold even today. So while there is an element of release of capital and potentially you could now lend more, we do believe that both banks and NBFCs will continue to be prudent when it comes to at least the consumer part of the lending.
What's the sense of correlation between these risk weights and the downstream impact on loans? I mean, if you increase by 20% or 25 basis points, what happens or has happened?
I would say it's more in terms of the messaging from the regulator as opposed to a direct correlation. But, just from a numbers angle, again, in that period, what the regulator discloses, say for banking system as sector deployment, they have a category called personal loans, which is largely covering overall retail loans, housing, consumer durables, credit card, and also what known as other personal loans. So if I just simply look at the category of other personal loans, again, growth rate was more than 27-28%. Even FY24 was about 20 odd percent. And if you see YOY, it was down to around 9 odd percent. So clearly there was an impact with both the risk weight increases that the regulator had done in that period. So we could say there's clearly a correlation on the C.
Conversely, now that it's been reduced, do you see demand going up, which of course is also a function of actual propensity to borrow, but how are you seeing it?
Two things. We do believe that banks as well as NBFCs will continue to maintain the prudence which they have displayed over the last 1 year and ensure there's better quality underwriting. But in a way, there's also a positive nudge where with the regulator having changed the risk weights, we think it will allow them to continue to reach out to the customer segment, the underbanked, underserved segment, especially with the NBFCs, for them to reach out and show some growth. we have to also, in our view, look at it in the context of the overall GDP growth. So we did see consumption slow down, and there is some bit of attribution that the urban consumption slowdown could also have been driven. And if you look at over the last 1-2 months, we've had a rate cut, we've had some income tax related benefits, and now we have these. I think a combination of these three would mean that there could be some impetus given in terms of the consumption lending.
In the past, when, let's say, risk weightages were what they were, not all banks and non-bank finance companies are equally aggressive. And I'm sure some were more than the other. So does this period mean that basically the aggressive ones become less aggressive and the others continue as normal? Or is there any rebalancing that happens or has happened?
I would address that in two parts. If you look at from a last, say, a decade basis, the banks were historically very focused on corporate loans. And, we did go through this whole challenges of the asset quality review. And there was this whole push to bring in granularity in the book. And which is why you saw across the banking system, there was higher emphasis on, retail loans in that period. NBFCs, if you see, more than 90% of the NBFC continue to be retail, I think there won't be any really change in it. From a bank point of view, on the other hand, today when you come, they are also grappling in a way with the challenges on the deposit side. So if you look at deposit and credit growth, they're more or less now matching at this period. And there are a few banks where the credit deposit ratio is probably much higher. So I would say the banks where there could be some more focus on this growth would be ones where relatively the credit deposit ratio is in a favorable state, because while there is this release of capital, you'll also need, at the other hand, the deposits to be able to try and show this growth.
Right. Ajit, thank you so much for joining me.
Yeah, thanks so much, Gil.